And then in 2007, 10 years to the month, I had $2.5 million in debt. And actually, our back was against the wall. We were hurtling down this little hole called the Great Financial Crisis, but we didn't know it, of course, at the time, because you can never see the future. You can only see in a rearview mirror where the economy is going. And in other words, you can't see the future. And so we were hoping that the worst of the economy, the problems were over in November of 2007, but they were just beginning, as we all know now. And so I went to a couple of friends. We met for coffee and they said, "What are you going to do?" One of them was my CPA's husband and said, "What are you going to do? Are you going to declare bankruptcy? What are you going to do next?" I said, "I'm going to give my way out of debt. Are you kidding?"
Welcome to the Physicians and Properties Podcast, the show where we teach you how investing in real estate can give you the freedom to practice medicine and live life how you want.
Doctor! Doctor! Doctor!
Doctor! Doctor!
Now, here's your host, Dr. 𝐓𝐢𝐦𝐞𝐬𝐭𝐚𝐦𝐩𝐬.
Hello, everyone. Dr. 𝐓𝐢𝐸𝐿 here with another episode of the Physicians and Properties Podcast. Today's episode was with none other than the great Paul Moore. This was a huge honor for me to have Paul Moore on the podcast. Paul Moore is an absolute legend in the commercial real estate space. He spent a stint with the Ford Motor Company and then co-founded a staffing firm where he was a two-time finalist for the Michigan Entrepreneur of the Year. He sold that firm to a publicly traded company and began investing in real estate. He's launched multiple real estate investment and development companies. He's been on HGTV, the Bigger Pockets podcast, contributed to Fox Business. He's written multiple incredible books such as Storing Up Profits, which is to capitalize on Americans' obsession with stuff by investing in self-storage, that was published by Bigger Pockets. He also wrote The Perfect Investment, Creating Enduring Wealth from the Historic Shift to Multifamily Housing. Paul is the founder and managing partner of Wellings Capital, a real estate private equity firm, and he is doing amazing things in the commercial real estate space. He has a passion for teaching doctors and other high network individuals what it means to be a boring investor and how being a boring investor can greatly benefit both you and your family for the long term. This episode was incredible. Lots of tactical advice and lots of fantastic advice about how to get started in the commercial real estate space. So without any further ado, let's get started with today's episode with my new friend, Paul Moore. Paul Moore, what an honor to have you on the Physicians and Properties podcast tonight. Thanks so much for taking the time to speak with us. I really appreciate it. How are things going?
It's going great. Alex, the privilege is mine. Thank you so much for having me on.
Awesome. Well, I've been a huge fan of yours ever since I heard you on Bigger Pockets, I think back in 2019. I mean, it was a long time. You were talking about self-storage investing at the time. And I'll be honest, my shiny object syndrome kind of perked up, and I was definitely interested in self-storage for a bit as well. So it's really cool what you've been doing in the self-storage space and all kinds of amazing things in commercial real estate in general. So really excited just to have you on the podcast, pick your brain, and share some good knowledge with folks. So thanks again.
Yeah. That's great. All right. Yeah. Thank you.
Paul, do you mind just telling folks a little bit about yourself for folks who aren't familiar?
Yeah. So I got an engineering degree, which was my first big mistake. Then I got an MBA, went to Ford Motor Company for almost 5 years in Dearborn, Michigan. And then I jumped out with a friend of mine from Colorado Springs and we started a company and it just went perfectly well, kind of almost scripted, providentially. And we were able to sell it to a public firm in like 5 years. And so I found myself, it was 1997. I was 33 years old and had a few $1 million in the bank. We moved to the Blue Ridge Mountains, the other mountains, and we started an international student ministry. And I thought, hey, I'm a full-time investor now. And actually, the truth is I wasn't. I was a full-time speculator is what I was. And I didn't know the difference. And, years later, I look back on that and I'm horrified to see, all the mistakes I made. Now I think investing is when your principal is generally protected and you've got a chance to make a profit. But speculating is when your principal's completely at risk and you've got a chance to make a profit. And there's nothing wrong with speculating as long as you know that's what you're doing. But I didn't. I should have known better. I lost a lot of money that way. I actually made a lot of money as well. But as I got into my 40s and then 50s, I did not want to live that way anymore. So maybe we'll get into that later a little bit more. But I went from being a speculative investor to, did a lot of residential real estate, flipped a bunch of waterfront lots at a resort, got into commercial real estate, and left speculation, I hope, behind me for the rest of my life.
That's awesome. What were some things during the speculation period for Paul Moore? What were some things that you learned, or if you don't mind sharing, what were some of the failures that you experienced during that period?
I had a podcast called How to Lose Money. I don't mind talking about failure, my friend. So I invested right off the bat when I had money, I invested with this Charlotte, North Carolina guy who was turning a 2 to 3% profit a month in some exotic foreign trading, currency trading thing. And I think he's on year 23 now of his 158-year prison term. And so that was one. And what I learned from that is following your gut is really important. So I'd already invested $100,000 with him, and I went to his house to meet with him to write him another $100,000 check. And I had a really, really bad gut feeling when I was talking to him, and he just seemed shifty. Something seemed funny. Now, so I didn't give him another $100,000. If I would have really had if I'd really been listening to my heart and my gut, I would have actually pulled the $100,000, or at least tried to, that I'd already invested with him out. But he ended up going to prison just 3 months later, or at least he was on trial just 3 or 4 months later. And so that was one. I've forgotten most of them. Another one was a wireless internet business that made total sense on paper, but it just took years and sucked $400,000 out of me and some friends. Another was an oil and gas deal that, though it could have been, something that, turned pretty nice profits, it actually, they changed it to be a very speculative type that would turn 100x profits or something. And it actually lost all the money in that. I've forgotten so many things. I did another deal with a guy in Colorado Springs. It's funny. It was actually taking a military pension and cashing it out. And then we were supposed to get the pension. You might have heard of those deals. And the guy somehow found a way to declare bankruptcy and get his pension back and not pay us. And so, I made a lot of mistakes along the way. I mean, even our first commercial real estate venture, it wasn't a venture, in the Bakken region of North Dakota, it went really well. We practically printed money, but it had one single point of failure, which I hate now. And that was oil prices. They were $90 a barrel when we started, about 90 to 100 when we sold the property, and we made really, really good money. But a year later, they were $30 a barrel, and I'm glad we were out of that project. But nevertheless, it was very risky, and I would never do that again.
Well, I think it's really important to learn from our failures, and I think it also is interesting. I know the end of your story, or I know, where the future led you amongst those learning opportunities that you had. And it's interesting when you say, I've forgotten a lot of them because I know you've had such incredible success. And so I think the important thing is, for folks listening too, is to not necessarily be afraid of failure, but try and mitigate the speculation and mitigate the risk. And like you said, listen to your gut, listen to your heart. Does this deal make sense for me? Pull the trigger and go from there. Yeah,
that's right. I really think we've been designed and created with incredible number of sensors. I don't know how else to say it, but I think we can sense 3,000 to 4,000 signals, like body language and tone and the combination of eyes and mouth. And we don't know that. Like, I can't consciously tell you, oh, that guy's lying, but our gut feels it, I think. And I think it's really important to not ignore that. Sometimes my gut or my sensory has a very strange similarity to the voice of my wife.
Yeah, mine does too. And I've noticed that she is often right. And so, super important. I think back to all the patients I see who come into the clinic and they're like, I'm only here because my wife told me to, and oftentimes they should have been in a lot sooner. If they would have just listened to their wife, they're right. So it's definitely true. That's awesome. Well, after we got out of the speculation period, what was next for you in terms of business and real estate?
Yeah. So like I said, we did a bunch of single family rentals and flips and small multifamily and a whole bunch of waterfront lots. Those were somewhat speculative. I did have a very significant period. I mean, I'll just tell you a quick side story. In 2000, I had a couple $1 million in the bank almost. And then in 2007, 10 years to the month, I had $2.5 million in debt. And actually, our back was against the wall. We were hurtling down this little hole called the Great Financial Crisis, but we didn't know it, of course, at the time, because you can never see the future. You can only see in a rearview mirror where the economy is going. And in other words, you can't see the future. And so we were hoping that the worst of the economy, the problems were over in November of 2007, but they were just beginning, as we all know now. And so I went to a couple of friends. We met for coffee and they said, what are you going to do? One of them was my CPA's husband and said, what are you going to do? Are you going to declare bankruptcy? What are you going to do next? I said, I'm going to give my way out of debt. Are you kidding? And what happened is I had been meditating one Sunday morning. I was just sitting in my chair journaling, and I just had this strange desire to really think through what George Mueller would do. Now, George Mueller was a famous guy in the 1800s in England. He cared for 10,000 orphans, all by prayer and faith. And he was a pastor, and he just like this incredible story. And there's just multitude of biographies written about this guy. But I thought, what would he do? And what he would do is something outrageous. And I thought, well, I'll just do something outrageous too. And I said, we're going to start giving. I told my family as well, we're going to start giving a certain amount to the charities we care about, our church, etc. January 1st, 2008. And every week after that, we're going to give that same amount and see what happens. And by January 28th, 4 weeks into this, I met a guy at a Subway restaurant. He was a real estate developer. And I said, I'm in real bad shape here. I said, I got this big parcel of land, lakefront land that I can't subdivide. When I bought it, I thought I could. That was speculative, by the way. And I can't divide it. He said, yeah, you ought to try this. And he told me some law that I knew about. And I said, yeah, that won't work. I already tried it. I thought through that. It won't work. He goes, yeah, you ought to think about it. And bam, right then, I had this light bulb moment of like, and 2 days later, I was in the county planning and zoning office meeting with the person that could make this decision, whether I could subdivide this land. And I was with my surveyor, who was about 65 years old. And he was like this. He was so embarrassed that I was proposing this crazy scheme, as he called it. And the lady looks up over her glasses. She was like pretty old. And she said, Mr. Moore, I've been working here for 38 years or something like that. And nobody has ever proposed such an outrageous plan. Then she laughed and she goes, but you figured it out. And she said, you figured out a way around the law. Nobody has ever come up with this in decades that I know of. And she said, you can do this. And so I ended up subdividing this land. There was a lot of hard work left. There was meetings with lawyers and surveyors and soil test people and realtors and bankers. But 18 months later, we were 100% debt-free in the middle of the worst financial crisis since the Great Depression.
That's amazing.
We even paid off our house.
That's amazing. That was some divine intervention at that Subway that day. That's for sure. That is incredible. Yeah. Was that Smith Mountain Lake? Yeah. Very, very familiar with Smith Mountain Lake. Got some friends who have some property there as well. It's beautiful. And so I think back, I spent some time there at Smith Mountain Lake, and that lake, it just reminds me of some of the lakes out here, actually, just how mountainous it is and just how beautiful and how large the lake is. It's incredible. So if folks are listening and you're looking for a good place to visit in Virginia, Smith Mountain Lake is a good one.
Yeah. 500 miles of shoreline.
Yeah. It's impressive.
Yeah.
That's incredible. Well, after the subway intervention there and getting those lots subdivided, was it off to the races after that?
Oh, no. About 2 years later, we invested in an oil and gas deal, and I mentioned that. We found out, though, that there were 19,000 job openings in North Dakota, and there was a massive housing shortage. So that's when we started, my friend from Colorado Springs and I started building multifamily / extended stay furnished hotels. They were really, cabins, like multi-unit cabins. And so we did really well with that. He went on and built a beautiful Hyatt hotel. I went on to be a multifamily syndicator. But, Alex, about 2, 3, 4 years later, I started feeling that bad feeling again. I started feeling like I was going to have to speculate to compete with a lot of the multifamily syndicators out there. I'd written a book that was actually selling pretty well called The Perfect Investment about multifamily. And I went on dozens and dozens of podcasts and I said, time out. It's not the perfect investment. If you have to over leverage, if you have to use floating rate debt, if you have to assume rents will continue to rise at 5 or 10 or 15% a year, and you continue, you believe your costs will be stable. And so I started going on lots of podcasts saying, don't do this. And we stopped. We actually created a fund at that point, and we basically decided to invest in self-storage, mobile home parks, RV parks, and other asset types, and multifamily only if we had some incredibly unusual situation. And we're now on our 6th fund. And this is the best and funnest thing I've ever done.
Awesome.
And so that's where we are now.
Why do you feel like multifamily investors are turning more towards RV parks, self-storage, mobile home parks, and they're getting fantastic returns doing it in kind of a turbulent environment? Why do you think that is? Or why is that working for you guys at Wellings Capital?
Yeah, so 93%, and it could be higher now, but years ago, a study said 93% of multifamily above 50 units was owned by multi-property owners, which are typically corporations, syndicators, whatever, who've gone in and they've already bled the value add opportunities out of those. And they often overpaid as well, though they didn't always do that. And so self-storage, 76%, at least at the time of the study, said were owned by mom and pop operators. In fact, 50% of all 53,000 at the time self-storage facilities were owned by single asset mom and pop operators. And often, and this is true for RV parks and mobile home parks as well, often those mom and pops don't have the desire or the resources or the knowledge to improve the property, to increase the net operating income, and to maximize investor value. And so you can go in and pay a fair price for that property and significantly increase the value. Here's an example. There's a property in Colorado Springs called AAA Platte. Now, you may know where that is. I think it's on Platte Avenue. It's on an east-west street that connects to Powers. And anyway, that property was acquired for $10.9 million, if I'm not mistaken. The retail was sold off. And then the warehouse, which was 95,000 square feet, just completely empty, was filled up with tenants. And we're talking about a professional operator. We were the largest investor, but the operator was our partner. And then they upgraded the self-storage. They fixed up the parking. They fixed up RV parking, et cetera. I think they mentioned they sold off a retail component. And the total resale on that was around $20 million. Wow. And if you think about the fact that it was only maybe $5 million in equity, that was basically, more or less probably tripled in about a 4-year hold. And that was but that sounds like crazy high, but that's like a normal deal for our operating partner in self-storage. He has another one in Grand Junction that was acquired for $4.3 million, and it was refinanced just 3 years later at an $8.8 million value. So it's pretty powerful when you can buy from mom and pops, pay them a fair price, and do a lot of upgrades. There's so many upgrade opportunities.
That's awesome. What are some upgrade opportunities for self-storage?
Yeah. So, I mean, you can think about selling retail items, locks, boxes, tape, and scissors, setting up a U-Haul partnership where you can actually get a portion of the U-Haul profits by running U-Haul out of there. And by the way, if you have U-Haul, you're likely going to get more tenants as well because they need a U-Haul and a place to put stuff sometimes. Expanding the facility. Sometimes these things will come with, maybe an acre of buildings and then 2 or 3 or 4 acres out back that have nothing that the, previous owner didn't value. Well, what about setting that up as RV and boat storage? Or what about building additional units? What about putting a cell tower in the back and a billboard in the front? What about a propane filling station or an ATM? I've seen all this, especially if there's an acre of land. You can sometimes, if there's those old style, drive up units, if there's demand is there, you can maybe build a 3-acre beautiful climate controlled facility, and you've already got the land, you've already got the location, you've already got the website, and it really does make a lot of sense. So those are just some of the many upgrade opportunities in self-storage.
Those are some fantastic tips. Do you feel like self-storage is getting closer to the point of saturation? It's definitely been, a hot topic in real estate over the last couple of years have been self-storage. Do you feel like we're getting close to saturation?
Alex, it's crazy, but yes and no. I can take you to Nashville and I can drive you around and you would laugh and you would say, oh my goodness, don't ever do self-storage here. It is so overbuilt. There's facilities everywhere. And I can drive you 10 or 15 miles south of Nashville to a suburb called Bellevue and another one, Belmont, and show you that there's hardly any self-storage, and it would be a perfect place to build a self-storage facility. Some of our most profitable deals have been in really remote locations like Grand Junction, Colorado, 𝐓𝐢𝐦𝐞𝐬𝐭𝐚𝐦𝐩𝐸, and places like a little town in Texas I'm forgetting the name of right now that was incredibly profitable. So it's overbuilt in some areas, but it's still undersupplied in others. And if you can buy a mom and pop for, half of what the value could be if you did all this work on it, well, that could be a good opportunity. AAA Plat, the one I mentioned right there in Colorado Springs, had several self-storage facilities right around it, but it went great.
That's awesome. Yeah, I would imagine, especially Colorado Springs being such a large military town with folks moving in and out all the time, that self-storage does really quite well in those markets. I don't invest in self-storage, but you're talking me into it. And, I'd imagine the military towns would be a good option or a good opportunity. Maybe in some of these smaller or tertiary markets would be a good opportunity to look at opening up a self-storage facility.
Right.
That's really cool.
I
Would
agree.
you say that self-storage is your favorite commercial asset class right now in terms of investing?
No, somebody asked me this earlier today, and I said, if I had to put money into one deal that I could not touch for 100 years, it would be tax-abated multifamily. However, if you ask me what I would invest in now, if I had to pick one of our 7 asset classes we invest in, I would actually pick mobile home parks. They are the only asset type we know of that has an increasing demand and a decreasing supply, or a stable supply every year. There's an incredible shortage of workforce housing. There are lots of ways. It's a great place to take care of people. These are where, some people crudely call these, metal boxes that spit out dollars. I'm calling this somebody's home. This is going to be someone's childhood home. And we want to create a nice place for people to live and to raise their kids in a safe place. And a lot of these mobile home parks have upgrade opportunities as well. The biggest upgrade opportunity is just filling vacant lots. If you think about a 200 space mobile home park that has 50 vacant lots, well, just bringing mobile homes and putting them on those lots and then selling them to individuals using, like one of these lending programs that will give them basically 100% financing on the mobile home. It is an opportunity to significantly increase the value of the park because, as you know, in commercial real estate, the value is not based on comps like residential. It's based on a formula. The math formula is the value equals the net operating income divided by the rate of return, or the cap rate, And that formula says, well, if you can increase the net operating income by 50%, all things being equal, the value of the park, the property goes up 50%. And we see this all the time in mobile home parks. I will say the one thing that keeps me up at night, actually nothing really does, but if there was one thing, mobile home parks do have the risk of really bad publicity because one or two bad apples, might really, really hurt their tenants. And you got a potential that the government would crack down on them and put in rent control and all that.
Yeah, I hadn't thought about it that way, but that makes a whole lot of sense. Yeah, I think one thing you hit on that's really important is, valuation of commercial assets. And there's so many cool ways that you can increase the net operating income and add so much value. I was talking to a friend who's pretty big in the multifamily space, and he was saying how just putting in a dog park can add hundreds of thousands of dollars worth of value in a multifamily property, making it dog friendly, putting in a dog park, and you've increased the value of this property by hundreds of thousands of dollars just by doing one.
Isn't that amazing?
Thing. Yeah, it's amazing. And I think it hits on what we talked about a little bit beforehand, kind of, investing in single family long-term rentals versus commercial. And does that make sense or not for a physician? What would you have to say in regards to that?
I hate to go back to something earlier, but let's just take what you just said, if you don't mind, and just run this out. So this is a mobile home park and a self-storage example. Bought a mobile home park in Louisville. And again, our operating partner bought it, had 2 acres of vacant land out front. The city wasn't going to permit any additional lot, but they would permit self-storage out by the road. Now think about this. I'm actually combining 2 stories. I just realized that. So it's not the Louisville one, but just to try to be integrous, I'll just tell you it was another property. But anyway, the mobile home park operator said, hey, there's extra cars. There's even cars on blocks. There's work trucks. There's trailers. There's boats and RVs. This place is a cluttered up mess. So he paved 1 acre of the 2 acres out front, put a fence around it, put a nice gate. He spent $120,000 doing that. Now, once it was rented up, that means the park was way significantly cleaned up. He could charge a little more rent for the park, and then he was able to open up whatever vacant spots were left to the community. He was able to make $10,000 a month. Now, you might notice $10,000 a month is $120,000 a year, which is exactly what he spent to do this. Let's do the math on what he added to the value of the park, though. At a 6% cap rate, which is somewhat conservative, take $120,000 a year in additional net operating income, divide by 0.06, that's $2 million he added to the value of that park. And he also cleaned it up and made it a nicer place to live. So that's the power of the intrinsic value available to people in commercial real estate. So just to take off on what you just said, is it possible to do that in single family rentals? I mean, maybe. But for most people, most doctors and IT professionals and dentists and lawyers that are investing with us, almost all of them, a huge percentage of them at some point tried to buy properties and manage them on the side. And they found out it was harder than they thought, way less profitable than they thought. And they were sometimes working, $20 an hour cleaning toilets or whatever at 2 a.m. on a Saturday night. And they were like, what am I doing? And so it's just not profitable for most people. And even if it was profitable, I'd have to ask you, couldn't you make more money by just doing a little extra locum tenens work or something rather than, this very, very risky, honestly, single family thing where you're trying to do it on the side?
Yeah, I agree. I think it's really difficult right now, especially in the current interest rate environment and where prices are for home prices. It's really hard to cash flow as a long-term rental in a single family house. And then, hey, what happens if you have to replace the roof or you have to replace the HVAC? There goes all your cash flow for a couple of years, probably, and so you're really going to need a stack of 20, 30 of these homes before you're making a significant dent in your income as a physician. I think there's some ways to, increase your cash flow, certainly maybe with short-term rentals or midterm rentals, but you're trading more of the passivity for increased involvement in that home to increase the cash flow. And so I agree. I think that commercial in some variety offers a unique way to get the economies of scale and really increase your cash flow and decrease the amount of time relatively that you're spending on working on that deal. So yeah, I think that's great, Paul.
Yeah, absolutely. I mean, I love seeing people set free to make, if they can make a similar cash flow from doing nothing except checking their bank account for the new direct deposit. And then they can get more time with their kids, more time with their family, more time doing important things, more sleep. I think that's a powerful proposition.
Yeah, absolutely. That's what it's all about. Physicians and Properties is about how docs can use real estate investing to get the freedom to practice medicine and live life how they want to. And I say all the time that freedom is a spectrum. It doesn't necessarily have to be full financial freedom. You never practice medicine again and you're sipping Mai Tais on the beach, because a lot of docs are never going to actually want to or be happy doing that. But it might be, hey, I have enough cash flow coming in from investing in this RV park that I can work one less shift and take that time to go on a date with my wife and spend some time with my kids. And so that really goes a long way as well. If a physician is sitting here right now, they're listening to this podcast and they're going, man, but single family is a lot easier to get started in. But this commercial discussion really makes sense. What would you say next steps would be for them if they wanted to kind of get more involved in commercial real estate investing? What would you recommend they do, or some good resources to reach out to, books to read, those sorts of things?
Yeah. If somebody really wanted to dive in, I would say get Brian Burke's book. Brian's a friend of mine. He's a multifamily syndicator, and he's got a book called The Hands-Off Investor. And it's brutally detailed and tells you how to vet sponsors. And it's like, I think it's 350 pages of really significant details. Do the due diligence, take the time. I mean, like I said, you're probably only going to be checking, your bank account for your direct deposit for the next 5 years, maybe even 10 years in some cases. It's worth it to do the due diligence up front to find the right people to send your money to. And it is worth it to avoid not only a crook, but just a newbie who doesn't know what they're doing. And I would say that's the next step. There's also some forums online that review and rate these syndicators and funds. And if you can find one, and you and I could talk maybe after the show about some that you may want to put in the show notes, that is a great way to help figure out, help declutter the whole thing and cut right to the chase. And if you're on a forum and 2 or 3 dozen people say they love this syndicator or fund and they've never lost a dime, and then 2 or 3 dozen on another one say we lost our money, or they stopped distributions, or there's a capital call, that's pretty telling.
Yeah, absolutely. Yeah, it's definitely worth it to do that due diligence and trust who you're investing in. And, folks ask me all the time about it. And, I've invested in a syndication and it's going great. And when you realize, hey, this is working out well, I'm checking my bank account and I'm seeing that direct deposit coming in, you're more likely to just keep investing with them in the future. And so the way to get more investors too, if you're looking at raising money, is treat your investors well, provide better returns than what they're expecting. And they're going to stick around too going forward and continue to invest with you.
Right.
Paul, I know you were at the White Coat Investor and 𝐓𝐢𝐦𝐞𝐬𝐭𝐚𝐦𝐩𝐬. And tell me about this boring breakfast that I heard about. What was that about?
One of the mistakes I made when I sold my company, I was a high energy type A entrepreneur. I had all this time on my hands and I thought a little bit like I was semi-retired in a sense. And so I actually thought I should get the same excitement and same charge out of my investments that I got out of being an entrepreneur. And that was a huge mistake. So I actually am on a quest to encourage doctors and others to seek boring investments. In fact, while I was at the 𝐓𝐢𝐦𝐞𝐬𝐭𝐚𝐦𝐩𝐬, I happened to walk past the main session, which I was not in. And Jim Dolly, the doctor, the founder, was talking about how important it was to get boring investments. So that was news, that was music to my ears. But anyway, boring investors, like the boringest 2 people I know that are successful in investing and God rest his soul, Charlie Munger, and they have the most boring lives imaginable. I mean, you can go read about them, their daily routines. Unbelievably boring. I don't know how most people could last a week doing what they do. And Buffett's been in this mode since the late 50s, daily. And Munger's similar. And so honestly, just not trying to get excitement out of your investing. Paul Samuelson was the first Nobel Peace Prize winner from the US in economics. And he said, investing should be boring. He said it should be like watching paint dry or watching grass grow. He said, if you want excitement, take out $800 and go to Las Vegas.
I like that a lot. Yeah, I think, we live in this culture that's so fast paced and so much social media, and you're seeing the guru with the Lamborghini that they probably just rented on Turo. That's not actually theirs, but you're seeing all that and you're surrounded by that all the time and all these shiny objects and speculative investments. And you think, hey, now maybe this is the one that's going to turn me into a millionaire overnight. Those are typically the folks that get burned. And it is important to figure out what to invest in, what you trust, and really know that and just invest in it. Like you said, consistently over time, and you're going to get there. Yeah,
right.
That's fantastic. Well, I also know that you are interested in fighting human trafficking, and I wanted to touch on that in the last few minutes because I think that is a hugely important topic. And, The Sound of Freedom movie came out, which was fantastic. And that fight for human trafficking is certainly ongoing. And so I wanted to give you a chance if you would like to talk a little bit more about human trafficking and what you guys are doing to help rescue victims of human trafficking.
Yeah, one of my historical heroes, in addition to George Mueller, was a guy who lived just before Mueller, and that was William Wilberforce. And he gave his life, his strength, his wealth, his relationships, everything, his health, to fighting to free slaves. And he actually was able to free slaves in England and, of course, Africa, the West Indies, and eventually in America. It was kind of a spillover effect from his efforts. And yet we find ourselves exactly 200 years later with more enslaved individuals than any time in world history. In fact, since we started our conversation a while ago, hundreds and hundreds of people have been sold or captured into slavery. I was shocked to find out that if you took the record, not the average, the record profits from Nike, General Motors, Starbucks, and ExxonMobil, record profits, added those together and then added about 20 or 25%. That's the average annual profits from human trafficking, according to the U.S. State Department. It's a tragedy, and it is worth fighting to free these folks. The problem is, just like investing in commercial real estate, who do you send your money to? Do you send money off to somebody you don't trust? Or just like investing in residential, do you really want to take it up on your own? I mean, is it likely you're going to go to South America like the guy in Sound of Freedom and, do a commando raid? Well, you might, but I'm not. And so we solved this by doing due diligence on an organization. We actually have a couple we really like. One's 𝐓𝐽𝐻𝐻𝐶𝐶, who put out an amazing movie 12 years ago called Nefarious. Now, there's a new movie called that too, but Nefarious from 2012. And then the other one is 𝐴IM. 𝐴IMfree.org is their website. We've helped influence, raise, and donate over $600,000 to 𝐴IM since 2021, and we're very excited to continue that quest.
That's amazing. We'll be sure to put in, links for those for 𝐓𝐽𝐻𝐶𝐶 and for 𝐴IMfree.org in the show notes so folks can check that out. And, I know the doctors are certainly passionate about human trafficking as well. So hopefully we can get some more donations just from this podcast. Definitely a big fight going forward, and grateful to have, people like you who are passionate about it, who are spreading the good word of these organizations who are really making a difference.
Yeah, thank you. Thanks for giving me the opportunity to share that. There's a lot of organizations who I think they do an okay job or a really good job freeing people, but if they don't give them a place to live, new job skills, relocation, food, clothing, they're going to go right back to the streets. In fact, the recidivism rate is horrific in human trafficking. 𝐴IM does a great job doing all that really well.
That's great. I'm happy to hear that they're doing that and setting folks up for success after, breaking them free. Paul, what, you know, if you were, as we kind of wrap things up here, what's one great piece of advice that's really stuck with you over time, or one, you know, some parting shots that you would give to the audience who's listening here? I know you have just so much wisdom and we could spend hours and hours talking, but I want to be respectful of your time.
Oh, thanks for saying that. One big thing is Warren Buffett has a lot of wisdom, and I think we could learn a lot from him. So one thing, when you come to that intrinsic value issue of commercial real estate and residential as well, Buffett said, price is what you pay, value is what you get. And so what you're going to want to look for, and this is, you know, again, I was talking about multifamily being so difficult to pull this off in because it's got so many eyeballs on it and people bidding it up. You know, if you can find a intrinsic value, like I mentioned, all those upgrade opportunities, for example, in self-storage in a property, well, that is a potentially great investment, because what you want to do is create another Buffettism, a huge margin of safety between the debt or what you paid and the value. And you can do that. That is a great thing to do. Another Buffett quote, unless you learn to make money while you sleep, you'll have to work until you die. And that's directly aimed at all my friends with white coats, you know, and that's why I know that a lot of people really appreciate your podcast. 2 people within a very short time recommended your podcast to me. One was at the White Coat Conference and another one around that time. And so I know you're doing great work teaching people to make money while they sleep. And that is what I recommend that people do. And that's why they should be listening to your show.
Paul, that really means a lot. Yeah, happy to hear that. And, you know, if only 2 docs from the podcast gain some value and are willing to share that with you, that'd be enough for me. So I appreciate that. And yeah, that just really means a lot. Thank you. Well, if folks are looking to find out more about you or to get involved with Wellings Capital and invest in with you, how can they do that?
Yeah, we have a fund open right now, and it's at Wellings, WELLINGS, wellingscapital.com. And if you'd like to get some free resources, ebooks, training on how to invest in self-storage, mobile home parks, RV parks, etc., you can get that at wellingscapital.com/resources.
Awesome. We'll be sure to put those links in the show notes for folks to get those free resources and to learn more about investing in the fund. Awesome. Well, Paul, thank you so much for coming on the Physicians and Properties podcast tonight. I really appreciate it.
Alex, it's been a great pleasure, and the joy's all mine.
That's
Thank
great.
you.
Well, with that, it's been Paul Moore and Dr. 𝐓𝐢𝐦𝐞𝐬𝐭 with another episode of the Physicians and Properties podcast. Signing off.
Hey, real quick, if you're still listening to this, I'm assuming you got value from it. So I need your help specifically. My 2-year vision with this podcast is to help 100,000 physicians learn how investing in real estate can give you the freedom to practice medicine and live life how you want. There are 2 main ways that a podcast grows. One is through ratings and reviews, and the other is word of mouth. If you can please leave me a 5-star rating and review on Apple Podcasts and Spotify, as well as send this to 1 to 2 friends that you think would get value from it, we can reach the physicians that we want to reach. Thanks in advance, and talk to you on the next episode. Please note that the information shared on this podcast is for informational purposes only and should not be considered financial or medical advice. The views expressed on this podcast are those of the host and the guest and do not necessarily reflect the views of the Department of Defense or the United States Air Force.